International trade. Consider for a minute how much you depend on international trade in your everyday life. Just take your cell phone. Chances are that at least some of its parts were made in China and Malaysia, and it was probably designed in the US or Canada. And this example extends to your car, your food, and even to your clothing. International trade is not just a nice idea, but it's an essential component of any economy. Some economies may consume more, while others may supply more, but trade between countries is an integral part of economic growth. A broader name for international trade is globalization. In business terms, globalization is the process of international integration that comes through an exchange of products. It's the way in which transactions bring our very large world together. While globalization is a modern term, the idea of buying and selling goods internationally is not new. During ancient times, traders would travel long distances via camel in order to sell their goods in a distant land. The difference nowadays is that due to modern infrastructure and communication, countries that were previously unable to trade with other countries are now able to trade all over the world. Globalization also benefits the consumer. The more choices that are out there in the market, the lower the cost of the product for the consumer. In broad terms, the greater the supply, the lower the demand and cost. Globalization also gives countries the opportunity to supply its citizens with items that it's unable to produce itself. And there are many factors that affect international trade supply, such as political events. If fighting between Saudi Arabia and Yemen shuts down a crude oil port, you can almost immediately expect crude oil prices to increase because of the decreased supply. Some countries are primarily consumers and importers, such as the United States, and some are primarily suppliers and exporters, such as Japan. These countries depend on their imports and exports, and an analysis of the balance between these two factors gives us insight into the strength of an economy. This analysis is known as current accounts. Here's an example of how a country becomes a supplier of a particular item. Let's say country C has a large supply of cotton and can therefore sell clothing for very cheap, but doesn't have a large supply of grapes and can therefore not produce wine at a low price. Country U, on the other hand, has a robust grape supply and can therefore produce wine for a low cost, but doesn't have a robust cotton supply, and clothing from country U is expensive. As you can probably guess, country C will focus its production on clothing and buy wine from country U, while country U will focus its production on wine and buy clothing from country C. This scenario forces country C and U to have very close economic ties, and the relationship can easily escalate to beyond just trade. Another advantage of international trade is that it encourages investing in foreign companies and assets. When an investor notices that a certain country is the main supplier of a particular item, and the investor believes the demand for that item will increase, they'll invest in that item, and thus invest in the supplying country. The integral role that international trade plays in our lives cannot be denied.